markets, despite the positive sentiment recently, they still remain rattled by the recent coronavirus outbreak, even as the global economy has been shaken and the Chinese have introduced measures to restore confidence. But the outbreak of the virus and global impact is not stopping the UK from trying to reset its trade relationships all over the world. So joining me to react to these developments is Lukman Otunuga, a research analyst at FXTM. Lukman, you are welcome, sir. Good to have you on the Global Business Report, Rise TV. Can you tell us what is the latest on the virus and how it's been impacting markets?
Good morning, and thank you for having me here today. Well, for now, it looks like the panic seems to be over. US stocks are trading back at record highs. European and Asian markets are recovering, and treasury yields are higher. Yesterday, we had unconfirmed reports of a possible breakthrough in treatment of the coronavirus, and this is supporting global risk sentiment, despite the World Health Organization going back against these claims. I think what's also supporting the market mood is the fact that we've had positive economic data from the United States, news that China has actually halved tariffs on 75 billion worth of goods, more than 1,700 products, and the fact that investors across the world believe that central banks are going to turn the taps on monetary policy easing. So I still believe that in the near term, we can see this positive market mood support global stocks throughout this week. However, though, as long as the coronavirus fears remain a major theme that's clouded with uncertainty, I think Q1 will be more pain and punishment for stock markets.
All right. Now, look, man, that sounds good. All right. Painting a good picture there, an optimistic picture. However, I have to ask, are markets prematurely assuming the worst is over? Which sectors of the global economy, for instance, are still vulnerable?
I think this is the case. You just need to look at the numbers. There have been over 500 deaths, over 28,000 confirmed cases. And as things stand out right now, it's quite difficult to quantify the negative impacts the coronavirus will have on the Chinese economy, Asia, and global economy as a whole. We have to keep in mind that the China of today is not the same as China almost 20 years ago. Back in 2003, China represented less than 5% of global output, but today China represents roughly 17%. So as they say, a slowdown or when China catches a cold, everyone will sneeze, and this is the case right now. There's three major global sectors I see being influenced or negatively impacted by the coronavirus. The first, of course, is tourism. Tourism will come to a complete standstill, especially in China, and going to China. Chinese tourists and those who want to travel to China will be stopped due to coronavirus. Secondly, we need to look at the airline industry. You know, airline flights to China, away from China has been halted due to the drop in tourism. And finally, manufacturing. You know, many manufacturing sectors in China are going to come to a standstill due to the supply disruptions and uncertainty the virus is creating. And this ripple effect will hit Europe, United States, and other emerging markets.
Thank you for that. Those are our key sectors, tourism, aviation, and manufacturing. All right, let's shift to commodities now. Let's look at gold and let's look at oil. How do you see these being impacted by what's been going on?
I still find it hard to believe that oil prices have depreciated roughly 17% since the start of the year now. I mean, for Nigeria, this is quite a big deal, but when we're looking at oil has been one of the biggest casualties of the coronavirus based on the fact that China is the largest energy consumer. So a drop in demand from China has the potential to destabilize the supply and demand dynamics of the oil markets. There are predictions that Chinese demand from crude oil could drop 3 million barrels a day. Now, this is almost double how much OPEC and OPEC producers are cutting. The OPEC have agreed to cut 1.7 million barrels a day. So my outlook for oil right now still points to the downside. Yes, yesterday we saw oil prices rebound roughly 3% due to the unconfirmed reports of a treatment for the virus. But when we look at the global growth and the demand dynamics, oil prices are going to trade lower. Now, it raises questions about the OPEC meeting. OPEC producers are speaking and probably may end up cutting deeper production cuts. This has the potential to pull a floor on oil prices. However, though, my theory in oil is all about demand. As long as demand is lacking, as Economics 101 states, when there's no demand, it's going to be quite difficult for oil to rebound and stabilize. Now, looking at gold, gold has struggled to actually exploit the risk aversion we're seeing across markets. The precious metal has only appreciated under 2% since the start of the year. I expected gold to push higher because when we look at the coronavirus, the risk it represents to the global economy and emerging markets, and the fact that it will force central banks across the world to start cutting interest rates, something that's good for gold. I was expecting gold to push higher, but when we're looking at the precious metal right now, I think gold remains in a tough tug of war with dollar. A stronger dollar versus gold. The dollar's appreciating due to safe haven demand, and it seems to be taking some of the safe haven flows from gold prices. So in the near term, I see gold possibly trading lower, back to 1550 and lower. But by the end of Q1, gold could jump back to 1,600, especially if trade uncertainty, global growth fears, and the coronavirus still remain major market themes.
Thank you for that. All right, so moving now to Brexit matters. Dominic Raab, British Foreign Secretary, is in Australia today. What do we know of the chances of success of the UK in getting new trade relationships as it pitches its businesses all over the world, especially now that they're 11 months away from the transition period of leaving the EU?
I mean, I believe this is a positive step for the United Kingdom to try to hash out trade deals with other economies across the world. But we have to keep in mind that trade negotiations take time, and the trade deal will not happen overnight. This could be an extended process. And we've got reports of the United Kingdom trying to secure a new trade deal with Australia. This is good. But the UK's biggest trading partners are the United States, China, Europe, South Korea. So while this is a move in the right direction, the UK will most likely continue focusing most of its attention towards hashing out trade deals with its biggest trading partner. As of things stand right now, this will be good for the United Kingdom. However, though, we just have to keep focusing on this 11-month transition period. Right now, official talks between the United Kingdom and the UK haven't begun, but there's already been sparks. It was only a few days ago that Brussels said that they had a trade deal, but only if the United Kingdom was to respect EU rules. But Boris Johnson has said that the UK will not respect EU rules. So this alone is going to create a lot of volatility and uncertainty, and this is something that is seen negatively impacting the British pound and UK economy in 2020.
Fantastic. Okay, got a few seconds left. Real quick, if you can. You mentioned the UK's biggest trading partners. You didn't mention Africa. So what about Africa and Nigeria? What does this mean for them with what's happening now in the UK focusing on spreading its business around?
This is an amazing opportunity for Africa and especially Nigeria. Just a few weeks back, we had the UK-Africa summit, investment summit, which saw Nigeria be the biggest winner. Nigeria was able to secure trade investments from 4 UK businesses of over 360 million. Now, this is an amazing first step, but this is going back to what I was saying, that UK may have less bargaining chips to secure trade relations with Africa, so this would be a good opportunity for Nigeria and other African nations to cement a new, lasting, mutually beneficial relationship with the United Kingdom. However, though, a lot of the focus, especially with the UK, be directed on the EU and the United States, meaning that African nations may be at the bottom of the list when it comes to trade relationships. I still think this is a positive step, and especially for Nigeria, who is actually in the process of diversifying away from the chains of oil reliance to other sustainable sources of growth like agriculture. This will be an amazing opportunity for Nigeria to really boost its agriculture produce and export agriculture to United Kingdom. However, though, I think everyone has a big part to play, and it's all about Nigeria macroeconomic fundamentals. Nigeria's economic fundamentals need to improve in 2020.
Got to end it there. Thank you so much, research analyst at FXTM, Lukman Otunuga, for his thoughts there.